If you could picture wealth in your head, what does it look like? Maybe a big house, a flashy car, or even a cushy bank account. Building wealth isn't just about earning money and buying nice things. It's about creating a legacy that will outlive you. Generational wealth allows your family to dream bigger, breathe easier, and focus on success instead of survival. But what is generational wealth? Where do you start? And how do you pass it on? In this video, I'm going to provide you with the blueprints to creating generational wealth by sharing tools and resources to lay a strong foundation for you and your family to build on. To start, let's make sense of your estate, also known as your net worth. That's any asset that can be passed on to provide financial security or opportunities for future generations. That could be money, personal valuables, real estate, businesses, or even life insurance. There are many factors that influence generational wealth. Some you can control, and others you have to overcome. The first and most obvious is existing generational wealth. Think the Vanderbilts, the Rockefellers, or even the Kardashians. You may not know much about them, but you've probably heard their names. Families with a history of wealth can give their children a financial head start, while others may have to start from scratch. Second, family dynamics play a big part. If one child does most of the work taking care of an aging parent, or maybe there are disagreements or estrangement, that can affect their inheritance, if they get anything at all. Personal finances are the third factor. Your saving and spending habits, debt management, and employment opportunities can determine how much is left for the next generation. Then, financial education. Your understanding of how money works and the knowledge you pass down play a huge part. We start learning from a young age how to manage finances, not only by what is taught in school, but by the behaviors we witness, the good and bad. Lastly, there are systematic barriers that have affected certain groups from building generational wealth. In the United States, women and people of color have historically experienced obstacles to financial growth due to outdated policies that in some cases prohibited access to important financial services and home ownership. Now, creating generational wealth starts with an investment, whether it's in property, finance, or even yourself. So let's talk about your options. I'll start with investing in home ownership. There are multiple ways your loved ones can benefit. The first is through equity, which is the difference between how much the home is worth compared to the amount owed on it. Over time, as property values rise, the equity can grow into one of your biggest assets. For example, if you have a $200,000 home but owe $150,000 on your mortgage, you would have $50,000 of equity. That equity can be borrowed against or used as collateral to start a business. The property itself can also be passed on to future generations, either to sell for earnings, turn into a rental as income property, or they can keep and live in it while continuing to earn equity. Depending on the situation, keeping the home could also mean lower or no mortgage payments, freeing up money for other things. Next, let's talk financial investments. Starting with lower risk savings options you can get at most credit unions and banks. This is where you make your money work for you. Certificates or CDs are a savings tool where you lock away a sum of money for a specified period of time, typically earning more interest than a traditional savings account. High-yield savings accounts also earn higher interest than traditional savings, but the money is not locked away and these accounts may have fees or minimum balances. Then we have money market accounts, similar to a high-yield savings, but with the ability to write checks, and often with higher minimum balance requirements. Moving on to investing in the market, which can be a higher risk investment as you can earn and lose money due to the market performance. But higher risks can mean higher returns. Now, before I continue, please note that I am not a financial advisor and that this video is not meant to give you personalized investment advice. But I can provide you with the information to give you a basic understanding. For official advice, you will want to meet with a financial or tax advisor. Here at Acentra, we have Acentra Retirement and Investment Services and First Community Trust to help our members with their investment needs, including stocks, which is owning a share or, in other words, a portion of the company you're investing in. Bonds are loans given to a company or government like a city or county that are paid back to the loan investor with interest. Mutual funds are a collection of investments that are shared by a group of investors, so both the wins and losses are spread out between them. Then we have retirement plans. These can be personal plans like traditional or Roth IRAs, or employer plans like a 401k. Depending on your plan, you can invest money in the market or a set interest rate. Now, the way these financial instruments can grow your money is through compounding interest, which is the interest gained on top of the interest earned from an initial investment. For example, if your initial investment is $1,000 and you earn $200 in interest, that $200 would be reinvested to buy additional investments. The interest gained from what is reinvested is the compounding interest. The idea is, the longer you invest, the more money you can earn in the long term. While buying a house and investing are practical ways to create generational wealth, they both require money. But what if you're starting from zero? Well, you could invest in yourself. Enrolling in college or a trade school has numerous financial benefits, the most obvious being higher earning potentials. According to the Bureau of Labor Statistics 2025 third quarter report, workers with a bachelor's degree make over $700 more on average each week than those with a high school diploma. Learning new skills and getting certifications opens the door for more job opportunities and career advancement. Both can come with higher pay. An often overlooked benefit is networking. Building relationships with instructors and students can turn into job leads in the future. Did you know that most jobs people get through word of mouth come from acquaintances, not close friends or family? So get out of your comfort zone and start networking. You never know what it could lead to. Now that I've covered how to create generational wealth, you should also know how to protect it. For starters, try to reduce the debt you have, because outstanding debt will minimize the amount of inheritance you pass on. Most debts are paid out of a person's estate before any assets are distributed, and any debt shared with a joint borrower becomes the joint borrower's responsibility. That's why debt reduction is so important, so your loved ones can inherit financial security and not a financial burden. Speaking of inheritance, don't assume that discussions about inheritance and estate planning are only reserved for the rich. People of modest means who do a good job saving through their lifetime, have paid off their home, or even just had a decent life insurance policy have already created an inheritance. But how does it work? First, I'm going to introduce you to some key terms. A beneficiary is the person or organization you specify assets to go to when you pass away. A trustee is the person or entity that manages the assets in a trust, which I will go over in a moment. A power of attorney is a document giving someone the authority to act as your legal representative while living, either making financial or medical decisions for you. How much control they have is decided by the language on the document and the power of attorney privileges and once the grantor dies or revokes the POA. After death, an executor is a person or entity assigned to carry out the terms of a will and handle an estate. Now, I'll explain estate planning options and how they work and other key terms. A will or last will and testament is a legal document outlining how tangible assets will be distributed and if a new guardian is assigned to minor children. Tangible assets are physical assets like your house, car, and other belongings. Intangible assets like financial accounts or insurance payouts typically have their own designated beneficiary and are unaffected by a will. If you do not have a will, an executor will be assigned by the courts when the estate goes through probate. Probate? What's that, you ask? Probate is the legal process of validating a will, identifying debts, and distributing assets to beneficiaries. Because probate goes through the courts, estate assets are typically made public. It can often take a long time and be costly. Those are some reasons many people set up trusts. A trust is a legal arrangement that allows a third party, the trustee, to manage assets on behalf of the beneficiary. By putting assets into a trust, they can be removed from the estate and protected from going into probate proceedings, saving money and time. In many cases, assets and beneficiaries also stay private, which hopefully leads to less disagreements in the family over who got what. Some trusts also offer tax benefits. There are two types of trust: revocable and irrevocable trusts. In simple terms, revocable trusts can be changed or terminated at any time, and irrevocable trusts are not easily changed. Life insurance also offers financial stability and is actually one of the easiest ways to pass on generational wealth. These contracts allow you to make an installment payment called premiums to guarantee coverage so that when you pass away, your beneficiary receives a sum of money. That can be used for income replacement if they rely on your income for bills and necessities, funeral costs, education costs, paying off debt, and money they can invest or further pass on. Since life insurance requires a named beneficiary, these payouts are typically protected from going through probate, and most life insurance payouts are not taxable. No matter which resources you use to start building generational wealth, it's important to remember the goal is creating a lasting legacy that not only gives your loved ones a step up, but empowers them to really thrive. You might think it's just about passing on money, but it's also passing down opportunities and knowledge to continue building on for future generations. So take this knowledge and start today. Teach your family what they can do so together you can create a better tomorrow for your kids, grandkids, and the generations that follow. Building generational wealth doesn't happen by chance. It takes learning, working with professionals to put your plan together, but most importantly, putting it into action. The future starts with the decisions we make right now.